It is my honor here to present you possibly the most eminent German economist, Professor Dr. Hans-Werner Sinn. He studied economics at the University of Münster and received his doctorate from the University of Mannheim. Since 1984, he has been a full professor in the Faculty of Economics at the University of Munich, first holding the chair for economics and insurance, and from 1994 onwards the chair for economics and public finance. In 1999, he became the president of the IFO Institute for Economic Research. Professor Sinn is internationally renowned for his analysis of the euro crisis, and to a great extent, the euro crisis provides proof for some of his previous work on the functioning of markets. Markets do not regulate themselves, but are capable of self-controlled processes inside an institutional framework provided by the state. Next to many research papers and scientific journal articles, Professor Sinn has written numerous newspaper articles and is a regular guest on television. He has published numerous books in German and in English translation. His latest book is titled Deutschland in der Targetfalle. Two other very influential titles are Casino Capitalism and The Green Paradox. The effect of Professor Sinn on policymaking cannot be underestimated. The German Business Weekly Wirtschaftswoche placed him in the #1 position among the most important economists in the country, and in 2012 he was included in the 50 most influential list of Bloomberg Market Magazine. Sehr geehrter Herr Professor Sinn, haben Sie vielen Dank für die freundliche Bereitschaft, hier für uns im Herzen Europas zu sprechen. Sie haben hier in Brüssel schon einen anstrengenden Tag mit uns erlebt, haben heute Mittag einen Lunch mit den Chefökonomen der belgischen Banken und der belgischen und flämischen Wirtschaftsinstituten hinter sich und haben darüber hinaus mehrere Pressetermine wahrgenommen. Gestern Abend sind Sie spät aus London eingetroffen und morgen fliegen Sie vor Tagesanbruch wieder in die USA. Wir möchten Ihnen versichern, dass wir alle hier Ihren unermüdlichen Einsatz für den Traum eines nachhaltigen europäischen Staatenbundes sehr schätzen. Sehr geehrter Herr Professor Sinn, es ist mir eine große Ehre, Ihnen nun das Wort erteilen zu dürfen. The floor is yours.
Sehr geehrter Herr Mons, Herr von Weinberg, Herr Verboven, vielen Dank, dass ich hier sein darf. Many thanks for being invited. It's a great pleasure to speak here at Pro Flandria about not a problem of Flandria, though, a bigger problem of the European Union, which is in deep problems. I'm an economist. I will just point out the economic aspects of the thing, how I see it, objective facts, plus at the end I come with some policy recommendations which are subject to debate, of course. Policy recommendations are always having an element of subjective assessment of different aspects, risks, advantages, which goes a little bit beyond science. But up to then, I want to confront you with objective facts, which I think, would have to recognize before we come to the policy section. The euro crisis. Here you do see the unemployment rates in the eurozone. And you see it's a spectrum of different developments. Germany was reducing its unemployment rate since 2005. At that point, we had the highest rate of unemployment in the Eurozone. Germany was in its own euro crisis at the time. That was the time of the Schröder reforms. But now everything is reversing, and here you see Spain and Greece moving up in the direction of 30% unemployment, which is a figure which we have had here in Germany and other countries in the Great Depression, 1929 to 33 in this range. So it is really a catastrophe. The youth unemployment in Spain and Greece is beyond 50%. It's moving towards 60%. But not only that, we see these ugly pictures everywhere. Protest, which shows that people are really discontent with the situation. To a large extent understandable, but there are pictures which one doesn't want to show, which would be a little bit beyond something one can tolerate. And I find it really terrible to see all this, given that the euro was announced 20 years ago as a big peace project for Europe by Helmut Kohl and by others, you may remember. And I belong to those who also endorsed this, and I feel guilty a bit because what we have nowadays under the euro is the worst we could have possibly have imagined. Martin Wolf from the Financial Times said, you have to be a masochist in order to make the same decision again had you known what came out of it. This is the truth. If we are honest with ourselves, we must accept that that is the truth. I heard that the ambassador of Greece is here. Yes, okay, so these are pictures from your country. So Southern Europe is in deep problems, as you see it in the demonstrations in the streets, and this is not the end of it. I think there's more to come. These are my themes. How did we arrive here? How did the whole thing originate? The bubble in the south. The loss of competitiveness of the southern European countries. The help from the printing press, the role of the ECB. I come to a country analysis, look at particular countries, and then I come to the policy evaluation and speak about necessary reforms as I think are unavoidable. The beginning of everything you see here. This is the interest spreads in Europe for government bonds. On the left-hand side, the pre-euro time, and here the current crisis. Germany is the red curve. Italy is, for example, yellow. Spain is here pink. So you see a whole spectrum. One country, your country, is not yet there. I added. This is Greece. There were interest rates above 20% before the euro was introduced, and at the peak of the crisis they were also high, and now we are again at a rather low level at 10%. Since the last summer, the spreads have obviously come down since Mario Draghi's OMT program, the announcement that he would buy the government bonds of countries in trouble, thereby saying that he would bring the taxpayers of the still solvent countries into the play and would impose the burden on them. That is what it means. Here you see when the euro was introduced. The euro was not only introduced in 2002, that was the last step when the cash was introduced. Actually, the crucial date is the first one here, the Madrid summit in December 1995. Then it was said that the euro would come, definitely, when it would come, and it was also clear which countries would definitely be in it. And it also was more or less clear when the irrevocable fixation of the exchange rates would be done, namely May 1998. That's the second bar here. And you see, within only 2 years from here to here, did the interest rates of those countries participating perfectly converge. Greece converged later because Greece only later in 2001 joined. But once it was clear, also the Greek interest rates came down. Why did the interest rates came down? Because before when we had separate exchange rates, there was an exchange risk for investors. And they wanted an interest surcharge to be compensated for this risk. Yeah, you bought Spanish government bonds in pesetas, and you didn't know what the peseta was worth at the time of maturity when you got your money back. So you asked for higher rates of interest in the first place. Then the currency risk disappeared. The closer we came to the point in time of this irrevocable fixation of the exchange rates, and so these risk premia disappeared. This shows that all of a sudden investors had more trust in the southern countries, dared to go there. The risk aversion disappeared, which implied that the interest rates at which the southern countries could borrow were lower. And they borrowed. In Greece and Portugal, it was primarily the government that borrowed in order to increase the wages and employ more government employees. In Spain and Ireland, it was more the private sector that borrowed. People built homes. This meant that there was a construction boom. Lots of construction workers found employment. Even Spain imported 6 million people from outside, often from Latin America, to help building the homes. So there were credit-financed wages and wage increases in the private sector, in Spain and Ireland, in the public sector, in Portugal and Greece, more or less. But whether the credit arrived in the private sector or in the public sector in the end did not make very much difference, because the respective other sector was participating. In Greece, the government employees built homes out of their credit-financed wages, and in Spain, the construction workers paid taxes to the government. So everything hinges together. Seeing the European crisis of today as a public sovereign debt crisis, for that reason, is too narrow. It's as much a private debt crisis as it is a public debt crisis. Actually, it's much more a private debt crisis than a public debt crisis. The foreign debt of Spain is larger than the foreign debt of all other crisis countries, including Italy, taken together. And that's a private debt, not a public debt. Well, the cheap money created a boom in these countries because there was money for investment, also for consumption. Wages increased, prices increased, and that, however, was a problem because the competitiveness of these countries was undermined by the inflation that resulted from this credit boom. For 10 years or longer, until 2007, everything seemed fine, but then the American financial crisis swept over to Europe. The interbank market broke down the first time in August 2007, and then the European spreads began to increase. Why now? Because investors faced the risk, saw the risk that they would not get their money back because of bankruptcies. In a sense, it's the same problem now as it was then. There were some over-indebted countries that could not repay. Here it was inflation and devaluation by which the repayment load was lowered, and now it is the risk of bankruptcy. It was only a short period of 10 years or so when the euro seemed to function in the way as the policymakers wanted it. In retrospect, it will be a short period in history. Now we have the trouble. Now in this crisis, certain things have improved. the current account deficits of the southern countries, which built up through the inflation. One lost one's competitiveness. Wages and incomes were inflationary growing, and that meant lots of imports were financed out of these incomes, while the export competitiveness was undermined by the inflation. That meant a huge surplus of imports over exports. That surplus needed to be financed, and it was financed with credit from abroad, and that credit stopped all of a sudden, 2007. And the current accounts had to react. These imbalances in the Eurozone have to shrink. They did shrink. Here you see Spain. That's the Spanish exports. That's the Spanish imports. These are the trend lines. And you see here, the imports are smaller than the exports, while they were much bigger before than the exports. So indeed, things have improved. But they have primarily improved because of the fall in the imports, not the rise in the exports. Yes, the exports have risen because after the clash of 2009, the world recession, everything was growing. So Spain is gradually moving back to the old trend, yes. But the primary driver here is obviously imports, the decline in imports. This is not quite what we want, because the imports decline because of the collapse of the economy. More unemployment, lower incomes, lower imports. It is not an improvement in competitiveness, what we see here. The improvement in competitiveness would require a realignment of prices. The prices that were driven up through this artificial credit-financed inflation would have to come down. That would be a structural improvement in competitiveness. People would buy domestic goods rather than imported goods because the imported goods become relative too expensive or the domestic goods become cheaper. That is what we want. Then we wouldn't have unemployment. But here this is obviously something which is driven by unemployment rather than a substitution effect. The same Greece. I could show you all the countries, they are all alike. Greece and Spain are the two extremes. Here the exports, they are not even back on trend, way back below trend, but the imports have come down. What we need is a substitution effect rather than an income effect. So we have to look at the prices. And this is my next theme. In this process of credit finance of the bubbles in Southern Europe, the prices increased enormously. Here you see the GDP deflator, that's the price index of the self-produced goods. You see how it increased from the time of the Madrid summit in 1995 until the Lehman crisis. And the red bars belong to the crisis countries. By comparison, Germany, at the lower end, had very little inflation, implying that the other countries lost their competitiveness and Germany gained it. The crisis countries, let me call them GIPSIC, the two I's are for Italy and Ireland, C for Cyprus, appreciated by 30% relative to the rest of the Eurozone. And Germany, in turn, cut its prices relative to the rest of the Eurozone by 22%. Economists speak of a real appreciation or depreciation, or real revaluation and devaluation. It's like having your own currency and you change that. For the competitive situation, it's the same. Whether you become more expensive inside the currency union or you have your own currency and that becomes more expensive for the trade relationship, it's exactly the same. One speaks of internal versus external devaluation, revaluation. And this is the problem of the Eurozone today. The prices went out of line. And now the price clock has to be turned backward. It went too far. It can't go on like that because the creditors are not willing to finance the current account deficits any longer. Too much unsustainable debt resulted out of this. To give you one example, compare Greece with Turkey. And I think it's a very good comparison because these are very similar economies with similar products. But Turkey's market price is determined by the market. I mean, the exchange rate is determined by the market. Greece is 61% more expensive than Turkey, if you look to the OECD purchasing power parity figures. Portugal is 43% more expensive. In order to be on the same price level as Turkey, that requires a real devaluation of Greece by 38% or of Portugal by 30%. Why 38? Well, if you're at 161 and want to come down to 100, then you have to take 38% away, then you're at 100. Another calculation of the realignment need by Goldman Sachs, a study which was published this spring or late winter, gives the following figures. Portugal and Greece and Spain would have to cut their prices by 30% relative to the Eurozone average. France, even by 20%. This is, for me, the most alarming figure which I found there. Italy by 10%. Italy is surprisingly little. Well, they do not exactly measure competitiveness. They measure debt sustainability. And Italy has little foreign debt. Ireland has no realignment need. And Germany, at the same time, would have to go up by 20% relative to the Eurozone average. So these are huge imbalances in the Eurozone in the relative prices that have to be changed. And this is the problem of the Eurozone. Either these realignments will take place in the next 10 years or so, or the euro will not exist. Because the structural current account deficits that result from the wrong prices will not then disappear. And even if they are there, no one is willing to finance them for such a long period of time. There are three options in principle which one has. First option is we cut the prices in the periphery through austerity programs. Means more and more mass unemployment. And the difficulty here is prices are very sticky downward. It's easy to increase prices, wages, prices, everyone is happy, but not the other way around. Unions define themselves by having wage increases rather than wage cuts. There's another argument. If the wage and price increases came through excessive credit in the private sector, then households and firms are indebted. They have to service their debt. You cannot simply cut their prices and incomes in half, say. Then they cannot service their debt. They are all bankrupt. And this is not an external debt problem. It's an internal debt problem. If they have bank debt internally. This is, by the way, the difference between Latvia and Estonia on the one hand and the southern European countries. Latvia and Estonia did go through a process of price cuts, but they had no internal debt. They just came out of communism, so they did not participate in this credit bubble. Those countries which came into the problem through the credit bubble can't go the reverse, can't do the reverse gear. That's the problem. If you nevertheless try with austerity programs, as the EU is currently doing, you drive these countries into mass unemployment to the brink of a civil war. And still you achieve very little. Keynes had discussed the same problem in his piece on the economic consequences of Mr. Churchill in the 20s, when he warned Churchill not to go back to the gold standard. He said, then we are too expensive, we will have to cut our prices, but we can't cut it. It will mean a mass unemployment because of the unions. But the internal debt problem is another argument which Keynes at the time did not mention. So this path is hardly possible, and if you try it, it will bring about a lot of hardship. The second is we inflate the core. Germany, Belgium, well, Belgium is expensive enough. But in order to achieve competitiveness for Greece and similar countries, without price cuts in these countries, Germany would have to accept an inflation of 5.5% for 10 years, increasing its price level by 71%, compound interest calculation, meaning that nominal wealth titles will lose 42% of their real value. Are the Germans willing to accept that? I doubt. The third possibility is an exit and depreciation. It's also a catastrophe because there will be a bank run. We see exactly in Cyprus what is happening if you have raised the expectation of an exit. There will be a bank run. People try to get their money out of the banks. And there could be lots of contagion effects, destabilizing the financial system. In other words, there is no solution. We are stuck in a trap. There is no solution. Sometimes there is no solution, even if we would like to have one. And we can only choose mixed strategies, a little bit of everything, or accept the problems with one of these paths which we choose. And it's a matter of value judgment where you think the catastrophe is smallest. Some sort of catastrophe is unavoidable. How much realignment in the Eurozone has taken place? Have we perhaps seen already, after all, in the summer we will have completed 6 years of crisis. Have we already seen some realignment of relative prices? Here you see the price level of Spain. Where this point here is set equal to 100, it's the time of the Lehman crisis. You see, before they were inflating, after that, indeed, the prices came down relative to the rest of the Eurozone. So it was a movement in the right direction. But you see, here they would have to go. It's quite a long way, according to the Goldman Sachs calculations. This is Portugal. This is Greece. This is France. This is Italy. This is Ireland. And this is Germany. So these changes in relative prices would, in the long run, not from now to tomorrow, in the long run, have to occur in order to solve the internal imbalance problems and make the countries of Southern Europe competitive again. If we want to avoid these price cuts, then we have to shift the whole spectrum upwards by inflating the whole Eurozone. And then the German bar means is so high that we will have our 5.5% inflation. That's what the previous calculation says. We can have any combination of these, but I tell you, these can be done through austerity programs. That is bound to lead to even more catastrophe in the southern countries. The European crisis has been largely communicated in the press as a financial crisis, as a crisis of a lack of trust, financial instability. Yes, it is a financial crisis after all. But the heart of the crisis is this. The financial crisis is on the surface. It's the pain which the European body feels. And our policies, which we have chosen, financial aid policies and so on, solving the financial instability, is a policy of giving painkillers. It is not a policy of rescuing these countries really and fighting against the true disease. Wrong diagnosis, wrong recipe. Of course, for the investors who have invested their wealth in the South, this is not the problem. Their problem is only that they get their money back. Therefore, they emphasize the public debate, in the public debate exclusively this financial stability thing and say to the public of Europe, unless you open your pockets and pay back instead of the debtors who can't, we will be nervous that we will have a financial crisis, and then we will all go under, and you with us. That's what the financial markets say in all crises, which is understandable, but not true. Some portfolios will go under, but not the world. Why has Ireland shown quite significant performance? After all, you see here, the Irish curve began very high and has come down from here to here, 2006 to here. They devalued by 15% relative to the rest of the Eurozone. That's quite a bit. And that has helped. Ireland had a current account deficit, now has a plus, and the market honors that. The spreads for Ireland are disappearing. Why Ireland? I'll give you the answer. The answer is that Ireland was standing alone when its crisis began. Their crisis came 2 years before the Lehman crisis. There was no special program of anyone, not of the ECB, let alone the community of states. So Ireland had to help itself, and they were forced into a brutal austerity program, bringing down the wages and the prices. Lots of pain. The other countries of the Eurozone, when they came into a similar situation as Ireland 2 years earlier, asked themselves whether they really wanted to repeat the Irish path. Given the pain it caused, they thought there are other options, other possibilities. And these other possibilities have to do with political decisions and through the mechanisms of the EU and the ECB. Actually, it was the ECB that they used to solve their problems. They solved their problems with the printing press. Now that the private capital was not willing to come anymore to finance their current account deficits, they borrowed from their local central banks, which issued more money for that purpose. And that money out of the printing press replaced the credit money that had come from the core countries. A simple model, actually, of the capital flows in the Eurozone is that the savers of Germany bring their savings to France, and the French banks distribute the savings in Southern Europe. Southern Europeans have the money and buy the German cars. So it's that circle. And that circle was interrupted So the French banks were not willing to lend further to the southern banks. Also German banks, of course, were directly lending. So the lenders did not want to do that, at least not at normal interest rates. And so instead, one was drawing the credit from the printing press. Let me explain what it is. It all has to do with this term target balances, target credit. So what is that? Target are net payment orders across the ECB system from one country to another. Before the crisis, money was flowing from a German savings bank to, say, a French bank, from the French bank to Greece, enabling a Greek citizen to buy a German car, and then the money was flowing back to Germany. In, out. No target balances. In and after the beginning of the crisis, this inflow of money was no longer there, but the money was still flowing out. So there was a net payment out of the country. A net payment in order to allow the goods imports to continue. But there was more than that. There was also a net payment out of the southern countries to the north, because the banks of the north not only stopped providing new credit, they also recalled the existing stocks of credit, which typically had a short-term maturity. So they recalled the stocks. Rather than rolling over the credit, giving one credit to redeem the old credit, they said, no, I want my money back. So the countries of the south, also for that reason, had to pay money to the north. And all this is measured by these target balances. Why do I emphasize the target balances? Because we have statistics about them. This is just a measuring device of what's going on. Huh? But if you make a payment order from the south to the north, that means a private bank tells its central bank, please send for me the money to the north. That means the money stock in the south is being reduced by this payment. The liquidity is being reduced. But there is not very much liquidity in an economy. 10 to 20% of GDP, not more. So you cannot do that on a sustained basis. You can only do that in the short term. You need a new provision of liquidity. So these net payment orders are in fact only possible if at the same time the local central bank generates more money, which it lends to the banking sector. So these things go hand in hand. The target balances directly measure the net payment orders, and indirectly they measure the reprinted money to refill the pot. So this is what you have to know. And what happens in the north? So the Greek central bank tells the Bundesbank, please pay a certain amount of money to Volkswagen, because the Volkswagen is to come to Greece. Then the Bundesbank pays the money to Volkswagen. By doing so, the Bundesbank gives the Greek central bank a credit. It carries out a payment order on its behalf. And therefore, this credit title is written into the books of the Bundesbank as well as in the books of the Greek central bank as a claim and a liability against the ECB system. Now, the Bundesbank carries out these payments. The payment arrives with Volkswagen. There's more euros in circulation in Germany, but one does not need more euros. There's only a certain amount of liquidity, so this extra liquidity is brought by the banks of the north back to the Bundesbank. They bring it back by redeeming the stock of refinancing credit they had taken already in earlier times from the Bundesbank. With any such transaction across the border, this existing stock was being repaid and shrunk and shrunk and shrunk. In the summer of 2011, it became zero. It became zero. And after that, it became negative, meaning that the German banking sector was a net lender to the Bundesbank rather than a net borrower, as is normal. So this is important because it tells us that with these net payment orders across the border, there are countervailing reactions of the money supply in these countries. By themselves, one country's money stock would fall and the others would increase, and that is automatically being sterilized so that the stocks of money balances in circulation remain constant. For the northern countries, like the Bundesbank and the Netherlands for that matter, this is a risk because the central bank now has a claim against the ECB system which replaces the private marketable claim which the savers of that country otherwise would have had against the southern countries. And this claim, however, is a little bit risky because if the euro system breaks up one day, then it's a claim against the system that no longer exists. And that is why Moody's announced in the last summer that it considers downgrading the creditworthiness of the Federal Republic of Germany and the Netherlands. Not as the only reason, but they mentioned this as one of the reasons. Here are the figures. This is the net money payments, the stock of net money payments from the crisis countries to the rest of the Eurozone. It was zero until Lehman, more or less, and then it was sharply rising here to a peak of 1,000 billion euros. That's what you find. These are the numbers from the balance sheets of the banks, of the central banks. And now they have come down a little bit since Mario Draghi's OMT program, giving safety for investors. So this is also a curve measuring the extra refinancing credit, central bank credit out of the printing press being provided in Southern Europe. But credit with freshly made money, not for the usual purpose of organizing the internal transactions process for local liquidity service, but for the purpose of buying goods elsewhere or redeeming your private debt elsewhere. And the counterpart is the target claim curve for the northern countries, Finland, Germany, Luxembourg, and the Netherlands. And you see it's more or less the same curve. But it's on the plus side. This is the amount of extra liquidity which came in through the payment orders, which was used to redeem the refinancing credit and even lend to the local central banks. So these were international credit flows between the countries. If you wish a simple metaphor for what is happening, the northern countries were lending their printing press to the southern countries. Well, that is what is happening. There is no euro in the Eurozone today which originates from a credit which a northern central bank has provided to its banking sector. All the euros in the Eurozone have been created through credit operations in the 6 crisis countries. All. this is the breakdown by separate countries. This is the most up-to-date list that exists. I'm sure the insiders in the ECB system have, again, somewhat more updated figures, but this is what we know. So Germany stands here with 600, the Netherlands 125, Luxembourg, and so on. And here on the negative side, Spain with a credit of 300 billion euros, and Italy with 250 billion euros drawn out of the ECB system. Why has this printing press so easily been accessible? You know, if you can't borrow in the market anymore to satisfy your needs, you just print the money and satisfy your needs. Why is that possible? That can't be possible. Something must be wrong in this story. It's too, if you think about it, it's too absurd to be true. But it is true. You can print according to the rules of the ECB as much as you wish. If I say print, I mean typically electronic printing. It's not physical. The only limitation is the collateral which those private banks which borrow the newly printed money have to provide in exchange to their central banks. In a small country, there is very little good collateral, so they cannot draw as much credit out of it as they might like. In a big country, you have more collateral, is marketable assets, is credit titles which banks have, securities which they bought with the newly printed money, and these securities they hand in to their central bank and say, here you have them, if I can't repay, it's yours. So one needs good collateral, and this collateral requirement is a certain limitation of the use of the printing press. But this was taken away in the crisis. Until Lehman, the collateral had to satisfy this standard, A-, which is quite good. But then it was reduced to BBB-, which is one step before the investment grade. It was reduced because there was not enough good collateral in the southern countries, so they could not use the printing press, but now they could. Because of the BBB- type, there was still enough assets in the portfolios of the banks. It lasted for a while, until this type of collateral was running out. Also, there was the problem that the rating agencies had declared the government bonds of Greece and Portugal not to be investment grade. So they reduced them below this standard. So what to do? Well, the ECB then declared, we don't care what the rating agencies say, we accept them as collateral, the government bonds. So again, the story could go on. Was not in all cases enough. Some countries took ELA credit. Emergency lending assistance. ELA credit is a credit like the other one, which a central bank gives with newly printed money to its local banks. But whether the local banks are able to provide a collateral or not is unimportant for the ECB, because the country itself guarantees that. So if the country declares, I guarantee the repayment, then these types of credits from the printing press are possible, even though no collateral is available. Greece has used about 45 billion. The exact numbers have not been published. This is just rumor. And the same for Ireland. And also Cyprus has used it a lot. I come to Cyprus. Then the ECB was allowing the banks to create ABS paper to use as collateral. What is ABS? Asset-backed securities. These are these sausages which were in the center of the American crisis, you know that. Bundled, structured securities where you had a claim against something else. You bundled claims. And as with sausages is normal, you do not really like to know what is in it. This was true for the American sausages and also for the European sausages. In Portugal, one found a sausage, an ABS paper, that included a credit title with a maturity up to the 31st of December of the year 9999. And in Spain, the credit titles which the banks had against the soccer clubs were included. Ronaldo from Real Madrid had been included in such a sausage because he was bought with credit which a bank gave to Real Madrid, and then this credit title was taken as a collateral, combined with other titles, and given as a collateral to the Spanish central bank. If the soccer club is bankrupt, as they are typically in Spain, and the bank is also bankrupt, the write-off loss will be shared by all soccer players in the Eurozone in proportion. And then one wants to allow company credit titles and so on. So one has reduced the quality of the collateral, and this is the reason why the head of the German Bundesbank, Jens Weidmann, a year ago, wrote a letter to Mario Draghi complaining about it. He did not do that publicly, but it became public. How, one doesn't know. But he complained about this collateral policy and the resulting extra use of the printing press, the resulting target balances. The relationship between the Bundesbank and the ECB is not the best. The Bundesbank was already against the rescue operations in May 2010, in particular the ECB's purchases of government bonds in the secondary market. And as the chief economist of the ECB revealed in a public speech, so I can say that recently, he and Axel Weber, the chief of the Bundesbank, had already at that time made a tentative agreement to step down out of their jobs. They didn't do that in that year. They did it, however, the year later, as you know, in 2011. First Weber, and then half a year later, Stark. They consider this not in line with the mandate of the ECB. The same is true for the OMT program. The Bundesbank is of the opinion this is beyond the mandate of the ECB. You could say there is war behind the scenes. War is, well, I take it away. It's too much. It's too much. But there is strife. What happened here in this period? The printing press was made available to substitute for the capital market. The capital market's conditions were too harsh, and so the banks of the southern countries preferred to take the credit from the printing press. The printing press was cheaper. It was underbidding the market. Whatever you think about right or wrong, this is another question, but it was underbidding the market. Perhaps the market was false, it was irrational, as my friend and colleague Paul de Grauwe would say, the market was stupid. They were hysteric, requiring too high interest rates, and so it was right for the ECB to undercut the market, perhaps. But you could also say, well, they cannot always be hysteric and always be wrong. In the long term, the market is right, and if the ECB does that forever, we have a problem. The evaluation is a little bit tricky, but as a fact, this is what happened. This is a fiscal policy. It is not a monetary policy. Why is it fiscal? Well, the aggregate stock of money balances is not increased. It is not inflationary. You cannot accuse the ECB of making an inflation policy. Second, by the electronic reprinting in the south and shredding in the north, you kept the stocks unchanged. So not even the regional distribution of the stocks of liquidity was changed in this policy. And that tells us it is really not a monetary policy. It's a fiscal policy. The ESM, which is supposed to give auxiliary credit to the South, what does it do? It borrows in the North. Say they issue bonds in the Frankfurt market. Money is flowing from Frankfurt via Luxembourg to Greece, enabling the Greece to redeem their private debt or buy the Volkswagen, and the money would return to the North. So after such an operation, the stocks of money balances would not change either. There is no economic difference between what the ECB is doing here and what the ESM is doing. It's the same. So this is a fiscal operation. And as such, I believe one can argue that it is not the mandate of the ECB to do that. But one can argue, well, it's good that we have it, because otherwise everything would have broken down. Again, two different views on what has happened. Yeah, I just explained that. Some people argue, well, these are abnormal times. You know, look at the United States. There they are pouring money at the economy to get out of it. They are doing the same. This is somehow ugly, but we cannot avoid it. This is not right, this argument. The Fed is pouring money, but it doesn't do regional policy. It would never take actions which allow the credit to be expanded in a particular region of the United States. There, the money comes into the economy in a slightly different way as in Europe than in Europe. In Europe, this so-called refinancing credit is given against collateral. And in America, the Fed buys market titles, which are traded, and becomes proprietor of these titles. But when doing so, it would always carefully watch that and make sure that the portfolio of titles it buys does not have a bias. And everyone in the States looks at this process, and if there is a bias, the Fed has a problem. The Fed would never buy, for example, state bonds of a state in trouble. California, they would not buy Californian bonds or those of Minnesota, which is also close to bankruptcy. And that is the fundamental difference. The ECB lends the printing press to the crisis countries from the north to the south, and the Fed does not do a similar thing. And also, there's one further difference. If nevertheless, they also have a sort of emergency liquidity provision, which is similar to the European refinancing credit. In some region, a local central bank prints more than is needed for its own liquidity provision for the purpose of its citizens to buy goods from other regions or buy assets in other regions or redeem the debt in other regions, so that there is a net payment of payment order from this region to other regions, then this district Fed has to pay with gold. At least this was the rule until 1975. Gold settlement was always the solution. The Fed was only founded in 1914. The dollar was in existence in 100 years without a Fed. Transactions took place between private banks. And of course, in America, it was also the case that the client of one bank told his bank, well, I want to have a product from the client of another bank. Can you please ask this other bank to pay out the money on your behalf? And you can withdraw it from my account. Yes, the other bank does that. By doing so, the other bank gives the first bank a credit. And if there wasn't a countervailing transaction in the other direction, then after a certain period, the first bank, which had asked the other bank to carry out the payment on its behalf, had to put the gold into a stagecoach and send the stagecoach through the prairie to the other bank. This is the scene we all know from our Western movies. The gold transports. This was the target balance settlement in the United States of America. When the Fed was founded, one said, this is too complicated, we cannot physically transport the gold, let's put the gold on one hip and then reallocate the ownership shares simply. That was the Fed. And that system lasted until 1975. But then the Bretton Woods system, which was also gold-based, had broken down 2 years earlier, 73, and so the Americans said it makes no sense to have these gold standard internally. But still they maintained the settlement with real marketable assets up to this day. In Europe we have a system like where you can go, it's like a grocery store. Well, you just don't have the money. You ask the shopkeeper, please give me the things I need and charge it on my account. That's what we have in Europe. And there's no point in time when you have to settle this account. You just keep it in the books as long as you wish. There's no limit. You have to pay a rate of interest, 0.75%. That's the main refinancing rate, but not more. I think we have to change that. By the way, in the Bretton Woods system, the gold base, it also was very similar. For example, all the Western European countries were part of the Bretton Woods system, and it was a fixed exchange rate system. There were balances of a similar sort. For example, French people had bought German cars and paid with francs. The francs were handed over to the Bundesbank. The Bundesbank had the francs and then had the right to convert them either into gold or dollars at the fixed political conversion rate. Since the market price of gold at that time was lower than the fixed price, France preferred to pay in gold. So did Britain. This is the origin of the 3,600 stock of gold which the Bundesbank possesses up to this day. The gold nowadays is 20 times as much as valuable as at the time, while the target balances will gradually evaporate with inflation. Let's look to the different countries. Here is your country. This is the target debt of Greece. You see it's limited until the crisis comes, and then the stocks which the Greek central bank reports in its balance sheet increase and increase. It's now about 100 billion euros. So this is a credit from the ECB system which the Greek economy has taken, has been allowed to take. Compare this with this line. What is this? This is the current account deficit, the accumulated current account deficit, where this point is fixed such that we have zero here. So measured from here on, this is the sum of the current account deficits up to this point. The slope of this curve shows the deficit, the annual deficit. There was a deficit all the time, before the crisis and after the crisis. Before, it was financed with private capital flows. Now the private capital flows stopped and credit from the printing press replaced it. And you see it's about the same number. So Greece has financed its current account deficit throughout the crisis years up to this day with the printing press. Public capital through the ECB system replaced private financing of current account deficits. This is Cyprus. Similar story. Also, Cyprus has not only now received public credit, 10 billion euros, they have already here received 10 billion euros from the printing press. And I tell you, given that the decision was to further open the printing press for them, this thing will shoot up. Maybe has already, because our data end by the end of 2012, they did not publish the further data. This is Portugal. 65 billion euros credit from the printing press. This is the accumulated current account deficit. It's a similar order of magnitude. Okay, here we see a gap, meaning that up to, what is it? Summer, early, May 2010. That was the critical day, actually, when the political decisions also were taken. The target debt, it did not increase as much as the accumulated current account, meaning there was a bit of private capital import. This gap here is the private capital import. But then came a capital flight, outright capital flight out of the country, which absorbed all the previous capital import and compensated for it. So if you sum over all these years, without looking to the different sub-periods, then it's again true that the current account deficit throughout the crisis, accumulated throughout the crisis, was financed with the printing press. Ireland, different story. Here's the Irish target debt. It peaked at here a level close to GDP, 150 billion euros. This is percentage points of GDP. And this is only the current account deficit, so it's relatively small. Much, much more than the current account deficit, meaning that this was an outright capital flight. So the banks of Germany, say, and Germany primarily, were withdrawing the credit from Ireland, and the Irish asked the Bundesbank to repay the German banks. So instead of having private claims against the Irish banking sector, the Bundesbank received a claim against the ECB system. That is behind these numbers. Capital flight. And this is Spain. I could give you, this is the last country I show you because it's always somewhat similar. Here is Spain. You see that up to 2011, the summer 2011, things were fine. About a quarter of the current account deficit had been financed with the printing press. 3/4 here were privately financed. But then came the capital flight out of Spain, and more capital was leaving the country than had entered since the beginning of the crisis. Summing up everything, again, the aggregate current account deficit has been more than financed with the printing press, because in net terms, capital has been exported from Spain to other countries during the crisis, private capital. What is my policy evaluation? What do we make out of this? What does it all mean? Well, let's first look to the aggregate numbers of all lending. This is the total credit from the printing press, about 800 billion euros to the crisis countries. This, in addition, is the government bond purchases in the secondary market by the central banks of the North, not by the ECB. The ECB does not buy anything. It orders the national central banks to buy the government bonds of particular countries, of the 6 crisis countries. This is the total intergovernmental credit, including everything, which Greece received, including IMF credit, EFSF, EFSM, and the new ESM, and everything. This is Ireland. This is Portugal, and this is the money that has now been provided to Greece. This is not the money which has been allocated to the countries, but the credit which has actually been drawn. The allotments sums are larger. So here's a little bit which I don't want to talk about. Some countries issue less currency than others, therefore they get in turn a credit claim against the ECB system, makes a total of 1,316 net credit drawn out of the out of some public credit channels, of which 26% was controlled by the parliaments and 74% by the ECB Council. I think this is something which we at least have to discuss. They try to keep it under the carpet and don't like to discuss it because it is, I don't know, anti-European or what to show these numbers. But these are the numbers, undisputable numbers. And we need to discuss what they mean. If the ECB was the Bank of England, I yesterday was there and heard the speech of Mervyn King, then this kind of operation is a fiscal operation which the ECB would not do it by itself, because that involves credit risk, wealth risks for various countries' taxpayers, and therefore needs to be decided by democratic institutions. So in Britain, we have two kinds of decisions: monetary decisions and fiscal decisions, or decisions with a fiscal implication by the Bank of England. The latter are always taken in accordance with the Treasury, a political body. The former are decided by the specialists of the Bank of England with their independence. Actually, if we now want to lever the ESM, as some people want, by a factor of 4, then we are talking about another 2 trillion euros or what that we could add here. I want to summarize what I have said by now by pointing you to a sequence of events in the Eurozone, which I perceive as a trap. That's the title of my book. A trap for everyone. A trap for the southern countries, which are stuck with excessive prices in an uncompetitive situation out of which there is no easy escape. The trap for the northern countries, which are part of or find themselves in a liability spiral out of which they cannot easily escape. There are 6 steps. The first step is the building of the credit bubble in the south by the introduction of the euro. The euro is, as such, has created so much safety feelings, say, for the investors that they dared to go to the south where they didn't dare to go before. And one wonders why this was the case, given that the Maastricht Treaty explicitly says, Article 125 of the EU Treaty, if a country goes bankrupt, no other country can help it. That was the recipe of creating uncertainty for the investors, Article 125. They should have hesitated before they went into countries where they were not sure about the political situation, but they did not. And one wonders why that was the case. We never really know. But one aspect is that the practical EU policy did everything to undermine the Maastricht Treaty, right from the beginning. In particular, by interpreting the Basel Agreement for bank regulation such that the banks had the right to buy the government bonds without holding any equity against them. The sum of risk-weighted assets to which the equity of a bank is related, when one speaks about a Tier 1 ratio, puts a weight of 0 to the government bonds because they are considered as absolutely safe. And this regulation is in strict contradiction to the Maastricht Treaty. It was undermining the Maastricht Treaty because it was suggesting a safety which the treaty itself was excluding. This has certainly contributed to inducing large capital flows, which drove these southern countries into their credit bubble, inflationary credit bubble, depriving them of their competitiveness. Okay, then the bubble burst. The printing press replaced the credit flow. That is the target thing. What should the ECB have done? I think nothing else but what it did. This is not a criticism of the ECB. It is, in a sense, unavoidable. And this is what I find so important in the sequence of events. Every step is nearly unavoidable. We are staggering along from one step to the next. We have to do what we do because otherwise the system falls apart. And then we can do some steps and the next crisis comes and then someone tells us, unless you do this or that, the thing will fall apart, so the politicians do it. And step by step, we end up in a situation, however, which we may not like. So the next step is government bond purchases. Trichet began with that in May 2010, when the EFSF was founded and so on. Why did he do that? Against the vote of the Dutch central banker, the Finnish, and the German one. So it was a majority decision against a minority to buy the government bonds of the crisis countries. He had to do it because the spreads were going up or the market values of the assets were coming down. And so the collateral which they had accepted for their refinancing credit was fading away. The ECB would have had to reduce its stock of refinancing credit in proportion to the declining market value because it's adjusted on a daily basis. And the southern banks would have gone bankrupt. The crash would have been there. So I do very well understand that the ECB said there is no alternative. We have to buy our own collateral. Otherwise, the banks go bust. And if the banks go bust, then we don't get our credit back, which we gave them. So it's a nearly compelling necessity. Mrs. Merkel once said all these things are without alternative. This is why Germany has now a party, Alternative for Germany. But she is right. She is right. There is not an easy alternative. The next step is the foundation of the ESM and EFSF, this permanent rescue program. Why this? Yeah, because the Bundesbank had told the politicians what the ECB does is illegal. We are against it. Then the politicians said, yeah, well, if this is so, we can just accept it as an emergency measure, but they cannot do that on a permanent basis. If someone buys the government bonds of the southern countries, it's us. We do it ourselves. So we create a fund to do exactly that, and then the ECB can step out. That was the argument with which, indeed, the majority leader in the German parliament convinced the party members. And indeed, the ECB, for a while, during the ratification process, did not buy any government bond. As soon as the ratification was done in the summer last year, Mario Draghi announced his OMT program. But this is not the end. Now we need to recapitalize the banks. At least this is what the politicians think. Why do we have to do that? Because the banks may go bust despite the fact that we buy their collateral and we announce buying the government bonds. After all, they have not only given credit to the governments, they have given credit to the private sector, and there are lots of write-off losses. You can photograph them if you look around in the Spanish cities. So we have to recapitalize the banks. Because if we do not recapitalize the banks, we have a problem. The ECB itself has this extra credit claim of 800 billion euros against the banks of Southern Europe, plus the normal credit. So if the banks go bust, the ECB, does it go bust? At least it has a problem. You can say they can never go bust because they can print the money. At least they would have a political problem if their balance sheet shows negative equity. So also, an understandable decision that in June last year, one was opening the ESM for the recapitalization of the banks, banking union. And this will not be the last step. The next step will be the Eurobonds. Because if France comes into trouble and Mr. Hollande asks Mrs. Merkel, either you agree to the Eurobonds or we will never marry, then she will say yes. She can't say no. He will be generous enough to allow her to choose another name for this, because she said it will not happen in my lifetime. But allow me this little joke. I hope you don't misinterpret it, but I think we are moving into another world gradually. Huh? It's another world. We have now 2 central planning authorities in the Eurozone that allocate the capital in space, the ESM and the ECB. It's no longer the market, it's no longer wealth owners who decide where to allocate the wealth, who determine where in space growth takes place and which part shrinks and so on, which used to be the allocative advantage of capitalism, the care of the wealth owner. It is 2 institutions that direct the capital. And we are having a problem with what a market economy means. Is this still compatible with a market economy? So, to summarize, the fiscal rescue operations are circumventing the parliaments, definitely. This is why the Bank of England always does it with the Treasury. There's a substantial risk imposed on core country taxpayers because these target claims would evaporate should the euro no longer exist. Also, the secondary market purchases directly impose the risk on the taxpayer because if the write-off losses occur in the books of the ECB, that means it cannot distribute its profits to the national treasuries, and the taxpayer foots the bill. The OMT program of Mario Draghi of last September is actually a program of asking the taxpayer to guarantee the investment in government bonds of the southern European countries. Because he says, before a country goes bust, I will step in and buy the assets, the government bonds, and put the write-off losses into my books. Meaning that the profit distributions will shrink to the respective treasuries. Then it is a low interest competition that expropriates savers. It's a policy of fiscal repression. You underbid with the printing press the capital market and thereby depress the rate of interest which the savers otherwise would be able to earn. That in itself is a huge wealth redistribution in the Eurozone. And in general terms, it's an allocation of capital through a central planning agency rather than the market forces. By the same logic, please allow me to be a little bit polemic. I know it's polemic, but sometimes this helps understanding the argument. We could say somehow it's wrong that German cars are so expensive. We should have a purchase organization for German cars that determines the price of the cars, and the German car makers can sell to that organization, and that organization distributes the cars elsewhere in the Eurozone at politically correct prices. That's exactly what the ECB does with the savings of the North. Exactly that. And what I find really most problematic is private debtor-creditor relationships are being shifted to the public arena, and that creates hassle and strife. Currently, we have private bank debt, we have private owners of these debt titles, and if there is a problem, they can go to court. The court can somehow resolve the problem, but in the future, the creditor is not a private creditor, it is another state. And all of a sudden, the states go into a creditor-debtor relationship. And they have no court above them to resolve the dispute. They will carry out the dispute in the public arena. And this is the recipe for hassle and strife in Europe. So I'm so glad about the turnaround which Dijsselbloem just announced yesterday in the case of Cyprus, saying that at least there will be bail-ins now for the banks. The creditors of the banks will have to bear the losses. We do not impose everything on the taxpayer. This was the last-minute rescue operation in this wrong course the European Union has taken. The EU Commission already last year said there won't be any bail-in until 2018. So they wanted this policy of making everything a public credit, lifting the credit from the private to the public arena. Is it what we do really a rescue? Does your country really benefit from what is being done? I doubt that. Those who benefit are the creditors of Greece. Every year we continue with this policy is another year they can escape. At maturity, they get their money back with new credit coming through these public operations. It doesn't help the Greek people. First of all, we maintain wrong asset prices in the country. Real estate remains expensive because there is the credit from the printing press. If Greece exited the euro, the drachma would be cut in half immediately, and all the rich people would come back to Greece. One says Greek people have parked at least 120 billion euros in Switzerland. This money waits until Greece has exited and the prices of real estate have come down. Then it returns. Then they buy, and then there is a building boom, a construction boom in Greece. Then there will be jobs and the economy will flourish. Second, by offering the printing press at conditions at which the market would never be willing to provide interbank credit, the ECB crowds out the interbank credit. The private interbank credit from northern banks to southern banks was evaporating because the ECB was there with the printing press. Otherwise, the interest rate would have gone up and it would have been attractive, despite the risk, to lend the money to the south. But if the printing press is there at 0.75% for 3 years with a meager collateral, it's always better to repay your private credit to a northern bank and take it from the printing press. And one calls that then capital flight. There are two interpretations. One is the capital flight is exogenous, the printing press steps in to help. The other interpretation is the availability of the printing press causes the capital flight. We cannot easily distinguish between these two interpretations empirically. Third, the necessary pressure on the countries to change their relative prices is not there, so the current account deficits are maintained. I repeat, however, that I don't think that the pressure will ever be large enough to do the realignment because it would squeeze the countries too much. Still, it's a collateral damage. And then the rescue operations create confidence for the capital market, and that not only means that northern capital goes to southern Europe, but also Chinese capital goes to Europe. We come to a revaluation of the euro. Here you see the euro exchange rate. You see whenever there was a crisis, things went down, and after the crisis, when there was some political actions, it went up. Here is Lehman, May 2010. No? When you create confidence in the market, then the euro goes up. Or here the OMT, euro goes up. But here is the Italian general election, the euro goes down. And it shows us there's a conflict between two goals. Political measures that calm the markets lead to a revaluation and undermine the competitiveness of the southern economies. Given that our political discussion is only focusing on one goal, stabilizing the capital markets, and forgets about the other, we carry out the policies which we do. So I end with the necessary reforms. I think first we need the American settlement system. You cannot have a system where you can just charge my account when you go to the shopkeeper. You need something. After a week or so, you have to hand over some securities to redeem your debt in the books. And if we do that, then this excessive use of the printing press would not be there. There would be still, of course, free payment flows across the borders, but the countries would not refill the pot easily with extra refinancing credit. Then we have to have an open currency union. I think rather than having this rigid thing and this quasi-religious statement, either everyone stays in or the whole thing breaks down, which is less convincing from day to day, we should say, if someone wants to exit, let him exit, but give him a return ticket. So if Greece wants to exit, exit. We help you. We help with your banks. We help with paying for sensitive imports. So to make it an orderly process. And then the drachma goes down, Greek becomes competitive, meaning that the Greek people stop buying Dutch tomatoes, but buy their own ones. Greece has a negative current account in agricultural products with the rest of the world. So that helps the farmers, creates jobs. Also the tourists would come from Turkey to Greece more. And then after a while, when the new exchange rate has found its equilibrium, return. The country can even legally stay in the Eurozone and just be for a while in a sort of hospital to recover. And after that, you return. That is better. I'm deeply convinced this is the only possibility for your country to come out of this mess. How long does the Greek people, tolerate a youth unemployment of more than 50% and an aggregate unemployment approaching 30%? It's not possible. Germany had that from 29 to 33, where we had to go through a process of austerity and real devaluation. There was shooting in the streets. And what came in 33 was even worse than a civil war. So it's not possible. This path which is chosen for Greece, for Spain, is not possible. And even if millions of politicians say it is possible, I don't think it is possible. For the reasons I gave you. Banking union, yes, in the sense of a common supervision and so on, we urgently need in the Eurozone. But money, it's another matter. We need debt equity swaps, and here we are again with Dijsselbloem. I think that's exactly what they did. Look at these numbers. This is the bank debt of the crisis countries. 9,200 billion euros. Some people say now we have rescued the states, we can also do that with the little banks, that's not an issue. But look at the numbers. By comparison, the public debt of these same countries is 3,500, so it's 1/3. This is just too big. There is no possibility for carrying out what the EU was thinking, namely public rescue operations for the banks of Southern Europe. It's just a number too big. Any percentage of this is already a horrific number, way above what the ESM could ever handle. There's only one group of people who can recapitalize the banks, and that is the owners of the credit titles, be them rich deposit holders. There's no one else in this world who can do that. Yeah, there is again. Here's my new hero, Dijsselbloem. Really very good. We will force all financial institutions institutions as well as investors to think about the risks they are taking on, because they will now have to realize that it may also hurt them. The risks might come towards them. And it is very good that he said that. He has been criticized by the financial industry. Of course, they don't like that. But there's more than the financial industry in this world. And then, if countries have difficulties finding finance, why don't you offer collateral to borrow? New York, when it went nearly bankrupt after Lindsay's social reforms, issued covered bonds where the coverage was prior titles to future tax revenue of the city of New York. So, by that trick, they were able to borrow at low rates of interest. Finland, after the Russian transformation crisis in 1995, issued covered bonds covered with real estate property. It was not the Finnish state, but it was this real estate agency that did it for the state. So there are possibilities. And then the interest rate would be low. What we should not do in Europe to socialize the debt. You know this person, this is my last slide. This is on every dollar banknote. Alexander Hamilton. In 1791, he socialized, or mutualized, as some people say, the debt of the American states. The United States had just been founded, and there was the war against the Brits, and he said this debt arose from the war against the Brits, and since we did not know where the front was, you know, it's all ours, we should socialize the debt. Made sense. And he argued this debt mutualization was cement for the new American state. Sounded good. Except over the years, things changed, the behavior of the states changed. There was the Second War against the Brits, 1813. Again, debt was socialized. And so the attitude developed among the states of America, oh, well, you can borrow as much as you wish. It will become federal debt. So I make a mistake if I do not borrow like my others. And so there was a lot of borrowing for infrastructure projects. Big canals were built, roads, many useful, but not everything useful. There was a big credit bubble in the United States, which initially was nice growth, but then turned out to be problematic because the states overborrowed. And the bubble burst in 1838. From 1838 to 1842, more than half of the American states went bankrupt. And the other states were close to bankruptcy. So there was no debt mutualization anymore. There was just hassle and strife as a result of this debt mutualization. I cite Harold James, the historian from Princeton University. He says the Hamiltonian scheme of federal finance did not guarantee a peaceful commonwealth. In fact, the fiscal union proved to be explosive rather than cement. Thank you very much for your attention.